A mixed week for the markets, with the narrative of local resilience versus overseas jitters still the common theme, best seen in the strong employment data released locally, in contrast with a cautious message from the US Federal Reserve. Our jobs numbers were slightly better than forecast, with the unemployment rate down to 5.8%, and just shy of 16,000 full-time jobs added to the labour force in February. So while the participation rate fell and part-time jobs declined, the 6-month average of total jobs growth on the chart is still running at 20,000 a month, enough to stop the unemployment rate from rising. In the minutes from the Reserve Bank's latest board meeting, they highlighted the uncertainty around the future trajectory of jobs growth, partly because of overseas concerns and partly due to local issues, such as population ageing and the complicated transition of our economy post the mining boom. But overall, they noted that leading indicators of employment were improving. The minutes also noted that surveys of business conditions were still above average, and business credit growth has picked up a little. And their retail liaison suggested there's been an improvement in retail trading conditions at year end, all consistent with interest rates on hold for now. But looking overseas, and despite the ongoing recovery in stock and commodity prices, the outlook is still murky, with the United States Central Bank announcing that global economic and financial developments continue to pose risks. So we're now only expecting 2 US rate rises this year at the most, compared to the 4 that had been previously forecast, which helps to explain why the Aussie dollar has had such a good run. As we mentioned last week, the AUD dollar has broken its longer-term downtrend that started back above parity and took us below US 70 cents. So now, having reclaimed 76 cents, it's a good reminder for businesses to always make sure you consider the possible impact on your business of a 10% move in either direction. This year was always going to be a volatile one on the markets, and the complicated and unconventional responses from central banks to overseas conditions will keep that the case. The higher exchange rate here will be a frustration for our Reserve Bank, but keep in mind the RBA will only ease cash rates if the higher Aussie dollar actually slows our economy. They're unlikely to reduce rates just on the risk that it might. Until next week, that's the market update from Bendigo Bank.